Welcome everyone. Today, we will explore the Modigliani-Miller theorem, a rigorous framework explaining capital structure irrelevance, investor arbitrage, and firm valuation in corporate finance. Core assumptions of the model. Under perfect capital markets, there are no transaction costs, no taxes, and securities are infinitely divisible and traded competitively. With homogeneous expectations, all investors share identical estimates regarding future operating earnings and firm risk. For riskless borrowing, both individuals and corporations can borrow and lend at the exact same risk-free rate of interest. Proposition 1, Value Invariance, no taxes. The core principle states that the market value of a firm is determined solely by its earning power and the risk of its underlying assets, not by its choice of capital structure. This is illustrated by the pie-cutting fallacy: dividing a pizza into more slices does not make the pizza larger. Similarly, splitting cash flows between debt and equity does not alter the total enterprise value. Mechanism of investor arbitrage. If a levered firm trades at a higher total value than an identical unlevered firm, rational investors exploit the discrepancy via homemade leverage. Investors sell shares of the overvalued levered firm and borrow personally to replicate financial risk. To restore market equilibrium, investors buy shares of the undervalued unlevered firm. Selling pressure pushes down the levered firm's price, while buying pressure lifts the unlevered firm until parity is restored. Arbitrage mechanism and price convergence. Arbitrage forces mispriced securities back to parity instantly, as investors capture risk-free arbitrage profits. Proposition 2, Cost of equity and leverage. As financial leverage increases, the required rate of return on equity rises linearly to compensate shareholders for financial risk. Although cheaper debt enters the structure, a higher cost of equity perfectly offsets it, meaning the WACC remains flat and completely constant. Why WACC remains constant, the perfect offset? The WACC equation shows that WACC is the weighted average of the cost of equity and the cost of debt. While it seems logical that adding cheaper debt would pull overall WACC down, a perfect offset mechanism takes place. When a firm increases leverage with more debt weight, equity risk rises, causing the cost of equity to increase proportionately. As a result, the cheap debt benefit is exactly cancelled out by the higher cost of equity, keeping WACC at a flat line. WACC and cost of capital versus leverage. Because WACC is invariant to leverage under Proposition 1 and Proposition 2, without taxes, the total firm valuation remains constant. Numerical example: unlevered versus levered. Looking at an unlevered firm and a levered firm, both generate an operating income of $1,000. While firm U has zero interest expense and a net income of $1,000, firm L has an interest expense of $300, resulting in a net income of $700. Despite these differences in structure, both achieve a total firm market value of $10,000 and a WACC of 10%. Proposition 1 with corporate taxes. When corporate taxes are introduced, interest payments become tax deductible, creating a valuable tax shield that reduces total government tax extraction. Because the tax shield increases linearly with debt, Modigliani-Miller with taxes implies that firms should theoretically finance themselves with 100% debt to maximize firm value. Thank you.